The greatest economic collapse in history did not happen in 1929. It did not happen in 2008. It happened in 1873, and almost no one remembers it. While textbooks glorify the Great Depression of the 20th century, the 19th century already lived through a longer, deeper, and more brutal disaster. 65 months of economic darkness. 43 months was all 1929 could manage. At the time, people called it the Great Depression. Only later did history rename it to make room for a newer catastrophe. What makes this forgotten collapse so dangerous is not only its scale, but its cause. It was not war, it was not famine, it was not plague, it was a technology bubble. A bubble built on steel, steam, and blind belief. Railroads were the artificial intelligence of the 19th century. Everyone believed they could only go up. In the 1870s, railroads were the internet of their age. They shrank continents. They moved goods faster than ever before. They promised endless growth. Towns appeared overnight along the tracks. Newspapers called them the future of civilization. Investors called them guaranteed wealth. Governments called them national destiny. The logic was simple and seductive. If rails connect cities, and cities create trade, then owning rails means owning the future. Money flooded into railroad companies. Banks lent without restraint. Families mortgaged farms. Workers borrowed wages from tomorrow to buy shares today. A new technology had arrived, and with it came a new religion. Progress could not fail. At the center of this faith stood Jay Cooke. He was the celebrity financier of his era, the man who sold dreams to the public. He financed the Northern Pacific Railroad, a line that would stretch across untouched wilderness. His advertisements described cities that did not exist, profits that had never been earned, routes that were not yet built. He sold railroad bonds the way modern markets sell technology stocks, with vision instead of revenue, with hope instead of cash flow. People did not ask how much these railroads earned. They asked how fast they expanded. Sound familiar? This was not investment. It was belief. The belief that a new technology made old mathematics irrelevant. The psychology was identical to every bubble that would follow. A new technology arrives. It changes daily life. Investors confuse usefulness with profitability. Prices rise, leverage multiplies, debt becomes invisible, risk becomes fashionable. Everyone says this time is different. Railroads were real. They transformed transportation. But the companies building them were drowning in debt. Tracks were laid faster than customers arrived. Infrastructure expanded faster than income. The system required constant new money to survive. When credit slowed, the illusion collapsed. But the collapse did not begin only with railroads. It began with a law, a quiet change in the monetary system. In 1873, the United States removed silver from its money. This act became known as the Crime of 1873. No riots, no national debate, just a technical revision that rewrote the rules of wealth. Silver had been money for generations. Farmers borrowed in silver, workers were paid in silver, debts were calculated in silver. When silver was removed, gold became king. The money supply shrank. Prices fell, deflation took over. The value of debt increased overnight. Those who owed money were crushed. Those who owned money grew stronger. This was not neutral policy. It was a transfer of power. Farmers and small businesses saw their incomes fall while their debts stayed the same. Railroads that depended on constant cash flow suddenly faced rising real costs. Banks and creditors benefited from scarcity. A dollar became more valuable. A loan became heavier. The system rewarded those who had capital and punished those who had borrowed. This is why people called it a crime. It was legal. It was quiet. And it destroyed millions. On September 18th, 1873, the illusion finally broke. Jay Cooke Company collapsed. The most powerful financial house of the railroad age failed in a single day. Panic spread across New York. Banks shut their doors. The stock exchange closed for 10 days. For the first time in history, the heart of global finance stopped beating. Businesses collapsed like dominoes. Railroads halted construction. Workers flooded the streets. Unemployment surged. Strikes erupted. Violence followed. What was once called unstoppable progress became uncontrollable collapse. The phrase too big to fail had not yet been invented, but its victims already existed. Companies believed essential to the economy vanished overnight. Entire industries froze, and the crisis did not end in months. It lasted years. 65 months of stagnation. No recovery, no rescue. Only slow erosion of wealth and trust. The technology survived. Railroads remained. They eventually dominated transport, but the investors did not survive with them. The assets passed into the hands of banks at pennies on the dollar. The winners were not the visionaries. They were the creditors. This is why 1873 matters today. Technology changes. Psychology does not. Replace railroads with artificial intelligence. Replace Jay Cooke with modern tech icons. Replace silver demonetization with digital money and interest rate control. The pattern remains intact. A new technology inspires belief. Belief attracts capital. Capital creates bubbles. Policy changes tighten money. Debt explodes and collapse follows. Railroads reshape the world. Artificial intelligence will reshape the world. But reshaping the world does not protect investors from mathematics. In 1873, the train went off the tracks. Not because it was useless, but because it was overbuilt, overleveraged, and misunderstood. Today, we sit inside another machine accelerating forward. Faster processors, larger data centers, infinite optimism, and the same assumption that growth cannot stop. History does not repeat. But it rhymes. The forgotten depression of 1873 was not an accident. It was a formula. Technology plus debt plus monetary shock equals collapse. The world did not learn from 1873. It buried it. And because it buried it, it repeats it. A society that forgets its first technology bubble will always be shocked by the next one. The real Great Depression was not in the 20th century. It was born in steel and steam, and its shadow is still with us. What followed the crash of 1873 was not a short recession. It was a long, slow suffocation. Businesses did not simply fail. They disappeared. Credit vanished. Prices kept falling. Every month made debt heavier and wages weaker. A loaf of bread became cheaper, but no one had money to buy it. This was deflation in its purest form. A system where production continued but consumption collapsed. For 5 years, the economy moved in slow motion while societies fractured under the pressure of hopelessness. The groups hit hardest were not speculators. They were farmers and workers, people who borrowed to survive. Their debts were written in gold value while their income collapsed in silver value. This was the hidden violence of the crime of 1873. It did not use guns, it used arithmetic. A single change in the definition of money shifted wealth upward. Creditors became kings, debtors became prisoners. The railroad companies that had built the future with borrowed funds now faced a present they could not pay for. One by one, they defaulted. Their tracks did not vanish. Their ownership did. Banks absorbed the remains. What had been built by public belief became controlled by private finance. Railroads survived. Investors did not. This is the paradox of every technology bubble. The invention wins, the public loses. The same pattern would repeat with electricity, with automobiles, with radio, with the internet, and now with artificial intelligence. The machine changes the world, but the wealth concentrates in fewer hands after collapse. The lesson of 1873 is not that technology is dangerous, it is that belief is dangerous. Investors believed railroads could only grow. They believed demand would always rise. They believed debt did not matter. They believed money would always be available. And when policy changed, when silver was removed, when liquidity tightened, the entire structure folded inward. A bubble does not burst because technology fails. It bursts because financing fails. Today, we live inside a different version of the same equation. Replace railroads with artificial intelligence. Replace silver demonetization with digital money systems and interest rate shocks. Replace railroad bonds with technology stocks. The vocabulary has changed. The psychology has not. New technology arrives. It transforms life. Investors confuse transformation with profitability. Valuations disconnect from income. Debt grows silently beneath optimism. And then policy intervenes. Liquidity shrinks. Confidence breaks. Mathematics returns. In 1873, people said railroads would unify the world. Today, people say artificial intelligence will replace human labor. Both may be true. But truth does not protect markets. Railroads became essential. Artificial intelligence will become essential. Yet, in both cases, most early investors will not survive the transition. The technology outlives the speculation. The infrastructure remains. Ownership changes. The forgotten depression teaches a cruel rule. Whoever controls money controls survival. When silver disappeared, farmers disappeared with it. When liquidity disappeared, companies disappeared with it. And when trust disappeared, governments lost control of the streets. Strikes erupted. Riots followed. Society questioned the legitimacy of its institutions. Economic collapse became political crisis. This, too, is familiar. History does not warn gently. It whispers through repetition. In 1873, the train went off the rails because it was built too fast on borrowed steel. Today, we ride another train made of algorithms and servers. It moves faster. It feels smarter. But it runs on the same fuel. Debt and belief. And belief always outruns reality before reality pulls it back. The real danger is not artificial intelligence. The danger is certainty. Certainty that growth will never slow. Certainty that new technology rewrites financial laws. Certainty that central banks can prevent collapse forever. These were the same certainties spoken in the age of steam. They were wrong then. They may be wrong again. The Great Depression of 1873 was erased from memory because another disaster replaced it. But forgetting it did not make us safer. It made us vulnerable. A society that remembers only the last crash never sees the next one coming. The first technology bubble showed the full anatomy of financial illusion: excitement, leverage, policy shock, collapse. Transfer of wealth, silence. This is why the question today is not whether artificial intelligence will change the world. It will. The question is who will own that world when the bubble deflates. Railroads reshaped civilization, but their original builders lost everything. Banks inherited the future. The same script waits for every technological revolution. History does not repeat. It rhymes. In 1873, the train derailed. Today, we're inside the next machine, moving faster than ever. And just like then, most passengers believe the track is endless. So ask yourself one question. Is today's technology rally a revolution that will lift everyone, or the final stage of another forgotten bubble? Write revolution or bubble in the comments. The past already knows the answer.